Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. We have a ripper episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot happening in markets. There's a lot happening in this episode. We were just looking at our prep doc and saying, God, we got a lot to cover.
We do.
So let's not dilly-dally. Let's get into it. Today, we're going to be covering the news that is making headlines around the world. We're then going to be answering a question on how we would teach young people to invest, what we would focus on. And then we're going to close out with a Pimp My Portfolio where Adam Dawes reviews the portfolio of an Equity Mates community member.
Before we jump into it, if you've just started your investing journey or you know someone who has started your investing journey, we've created the Ultimate ETF Handbook. It's a free downloadable resource. It's available in the show notes or the description below. Click the link and you can download it. It'll take you from zero to everything you need to know to build a portfolio of ETFs. Check it out. It is free to download.
And markets.
All right, well, Bryce, as I said, a lot of news. We're going to cover the latest GDP numbers in Australia, Commbank's record Milestone, Virgin's IPOing, Trump's new tariff news, OpenAI's growth. Then we're asking what on Tinder's latest update. A lot to cover. Let's get into it. Let's start with the Aussie economy.
Aussie economy, it's grown 0.2% in the most recent quarter, up 1.3% over the past 12 months. It is barely growing.
Still growing.
Still growing, just. Growth has slowed. The previous quarter we grew 0.6%, but it is doing better than many other economies around the world that have contracted, i.e. the US economy has contracted 0.2% for the March quarter. So not all bad news, but man, we are grinding.
Yeah, but
growth is growth.
I'd prefer to be in our situation than a lot of other economies right now. Save our housing situation, but we're not talking about that in today's episode. Let's talk about a company that has benefited from the Aussie housing pump. Maybe one of the biggest beneficiaries, the most expensive bank in the world, just got more expensive. Commonwealth Bank became the first Australian company to be valued at more than $300 billion.
It is wild. It is a stock that continues to baffle the Aussie stock market, and many fund managers hear about its wild valuations. Let's put it into perspective though, because as you said, Ren, it's the world's most expensive bank, currently trading on a 32 times price to earnings ratio. Now, if we compare that to some of the biggest investment or biggest banks globally, JP Morgan is trading on 13 times, Wells Fargo 14 times, and HSBC 11 times.
But even bring it back to Australia, and it is out of range of its peers. NAB trades on 17. Westpac also trades on 17 times price to earnings. ANZ on 13 times price to earnings. But I think if we just pause and just reflect, we talk about the big four banks.
Yeah.
You've actually started trying to talk about the big five banks and include Macquarie in there.
The Bank of Mum and Dad.
Which they would be stoked by. But Commonwealth Bank is now worth $300 billion.
Yeah.
Do you want to have a guess at what the next largest bank is?
It's NAB.
It is NAB, $118 billion. And then do you want to go after that?
ANZ?
No, Westpac, $113 billion. ANZ, $89 billion. So we talk about the big four banks, but you could almost add those three banks up to get Commonwealth Bank.
That is crazy.
Yeah, almost like that. Yeah, but it's no longer, it's the big one and then the next largest three. But yeah, congratulations Commonwealth Bank, I guess. More congratulations to Commonwealth Bank shareholders. Shares are up 47% in the past 12 months, up 86% in the past 2 years, almost doubled in the past 2 years. Those numbers are before dividends as well.
Oh my goodness.
So Commonwealth Bank, who knows how long it will continue. You would think mean reversion has to set in at some point.
Yeah.
But Aussie fund managers have
You
thought
would
that
think
for the
so,
past
but
2 years.
Yeah, literally. It's been the story of the last 2 years.
Let's turn to another story that's been playing out for a number of years. Virgin Australia has been playing a bit of a game. Will they, won't they IPO? It seems, Bryce, finally they're going to commit to listing again.
Finally, yes. They're planning to list, obviously, here in Australia, which is good news. They are currently owned by, well, you never know, it could go elsewhere. Try and list on the NASDAQ. So the story is the company almost went under during COVID. Private equity firm Bain Capital came in and essentially bought it and delisted it. And they have now announced that they're going to be taking it public again, raising $685 million as part of their IPO.
Question without notice. Qantas or Virgin? Which one are you buying?
Qantas.
Fair enough. All right, well, let's go overseas because there are some news stories playing out there as well. Let's talk Trump. Let's talk tariffs. There's a lot going on. There's a lot of noise. Has the federal, what is it? The Court of International Trade blocked his tariffs, overturned on appeal, but likely going to the Supreme Court. But the news of the week is that they raised the steel and aluminium tariffs, or as the Americans say steel and aluminum tariffs, from 25% to 50%. There was a quote that Trump gave, which was like, at 25%, foreign producers can find a way to jump over the fence. Yep. At 50%, they can't.
No chance.
So like they've made it pretty explicit that they don't want foreign producers selling steel in the country. Interestingly, an Aussie steel producer might be one of the biggest winners. BlueScope has a massive US operation. About 50% of their profit comes from their US operation. And all of a sudden, they're going to have more pricing power in the US.
Yeah.
Yeah.
Interestingly as well, Ren, the impact of his tariffs on the industry in 2018.
I was going to bring this to
you. It was in our daily newsletter.
True.
Had nowhere near the effect that I think they hoped. So in 2018, he brought in some tariffs, increased jobs by about 1,000. And then, correct me if I'm wrong, but I think lost jobs across total manufacturing to the tune of about 70,000.
Yeah.
Yeah.
Close enough.
Close enough numbers.
Added 1,000 jobs in the steel industry in the US, but US manufacturing lost 75,000 directly related to the increased input costs.
Crazy.
Yeah. Let's stay in America. OpenAI, hottest company going around at the moment. I think it's fair to say these numbers will certainly make it a little bit hotter. In the last 3 months, OpenAI has increased its paid user base for ChatGPT by 50%.
So that takes it to 3 million paid users for ChatGPT, as you said, Ren.
Feels small.
It does feel small because when you compare that to its weekly active users, the stats are 800 million.
All right. Okay. That feels bigger.
Yeah, because I remember it was the fastest growing app in history.
Yeah.
Didn't it? To get to 100 million users.
Yeah. It was like in a week or two or something. Yeah.
So I'm not surprised with this growth. I honestly would have thought it'd be more than 3 million paid users. We are one of them here, and I think about this as well. It's just the amount of AI things we're going to be subscribing to in the future, I think, is going to be wild.
So those numbers actually put an article I was reading in Bloomberg this morning in perspective, which is, so keep that in mind, 3 million paid users, 800 million unpaid users. Bloomberg are reporting that they're now, all these AI companies are now looking at advertising. And in particular, OpenAI just hired Instacart's CEO to lead their advertising efforts. Which I have a number of thoughts on. First of all, not great for Google. Secondly, not great for the ChatGPT outputs, I think.
Yes.
You don't want advertisers to influence the output.
Yeah.
But then there's also something that they were speaking about. It's called, I might get this wrong, but it was like intuitive advertising or something, or intentional advertising, where it's like your questions reveal your intentions, and then they nudge you in certain ways in the answers. They realize you're feeling sad or depressed, and they start nudging you to book a certain holiday, or to, if you're in America and you can advertise pharmaceuticals, they nudge you towards certain pharmaceuticals. It's like people see AI as a source of truth. Advertising will distort that source of truth, and in the same way that social media was free and it kind of got ruined by advertising, and it fucked up our brains and our society. You don't want AI to go down a similar route.
No, that's true. That would be disappointing. I was thinking as well, like AI is, for me, the trust that you put in the output of AI versus other for me particularly versus other like technological advancements, I think is wild.
Yeah, it's a source of seen as a source of truth.
Seen as a source of truth. Yeah. Have you seen what Zuckerberg's now been saying about how he's just going to radically change how Meta does advertising?
Yeah, fully automated with AI by the end of 2026.
Literally, please like plug in your bank account to us, and we will do everything. Forget agencies. Forget all of the media and design agencies. We will literally take your bank account. We know what products you sell, and we will do everything.
Yeah. We'll design the creative.
We'll design it. We'll optimize it.
And
then we'll just show you the results.
Yeah. I mean, hey, if any companies want to plug their bank accounts into equity maze, we'll use AI to fully automate your advertising as well.
Oh my goodness.
All right, well look, that's a whole other conversation that we can go down, but let's close out by asking what the, and a reminder that every day in our daily email we include a what the for a business news story that has caught our eye and surprised us. But today we're asking what the about Tinder's latest product innovation and what it reveals about the company beneath it. But let's start with the product innovation. Now, Bryce, you met your wife when you were still at uni and you guys
analog days.
Dated for 10 years and then got married. Never really needed to go on dating apps.
No.
But for the rest of us who have dealt with dating apps, the Tinder's latest product feature came as a surprise. A height filter.
Jeez. That's a bit of a tall order.
Oh, God.
Does that work?
As a joke?
Yeah.
No, that's not great.
Anyway, you're right, Ren. They've introduced a height filter.
Now, so for paid subscribers, they can now filter on height. You know, only guys over 6 foot is probably going to be the most commonly used height filter. Obviously controversial. But for us, it reveals something about Tinder's parent company and how much it is struggling at the moment. So Tinder is owned by Match Group. Match Group owns dozens of dating apps and websites, Match.com, Plenty of Fish, Tinder, Hinge. I think that's about all I can name, but there are dozens that they own. Match Group's share price down 82% in the past 4 years.
Wild.
And a key reason for that is that paid subscribers are falling. They've fallen for 8 consecutive quarters. And in particular, young people are leaving dating apps.
Love that. Leaving dating apps, drinking less. These guys are on it. Well, yeah. The next gen.
Yeah, but I mean, like if you listen to Scott Galloway and some of the research he's done, you know, young people aren't doing too well.
True, overall.
Yeah.
But I mean, if they're leaving and finding more success in the real world, that's good.
No, but I think the problem is a lot of young people aren't finding...
Young men
in particular aren't finding...
Yes.
Yeah. Anyway, separate conversation. So, a key reason, survey after survey tells us a key reason why Gen Z and Gen Alpha are not using dating apps is because they find them superficial.
I can understand that.
Well, I'm not sure a height filter is going to change that perception.
Very true. That's very true.
But yeah, it's pretty dire straits for Match Group.
Yeah, well, I mean, particularly with AI and the creation of bots and all these sorts of things, like you won't know what to believe when you go on these apps anymore.
True.
Yeah.
True. Well, yeah, people just lie about their height, I imagine.
Very true. Yeah. Yeah, true. 6'8". Is that even a height? Yeah.
Yes, that is a height. So look, probably. I mean, I was about to say I'm probably short Match Group, but it's already fallen 80%.
Gone. But you're not an investor. Though.
No. But anyway, that's an interesting one. I wanted to close with this stat from The Economist. Tinder's user base, 84% male.
Okay. Again, not surprised.
I was pretty surprised by that.
But it was like the OG. Yeah. I feel like that's why a lot of the other female ones have sprung up, right? Because of OG Tinder.
So Bumble is obviously where women make the first move.
Yeah.
61% male.
Right.
So
maybe all apps are just dominated by male.
I think men are just more desperate.
Yeah. Investing should be taught in schools. Here are the lessons that we would teach. Today's segment was inspired by a question from Ryan.
G'day guys, my name's Ryan. I'm a teacher out of Brisbane. I've been a big fan of the show for the last year, learned a lot about investing, so thanks for that. But I'm finally at a stage where I start to feel comfortable maybe teaching a unit on this with a Year 9 class. I've got permission from my boss to construct a subject about it in Year 9 business. I was hoping you'd give me some advice about maybe what are the top 3 things you would want to have your kids know at a Year 9 level to get them passionate about investing. Cheers, guys.
Love that, Ryan. What an awesome question, and so good that you're thinking about getting this into the classrooms. If you would like to ask a question like Ryan did, head to equitymates.com/contact, leave us a voice note. Ren, before we jump into this and answer what we would actually teach Year 9 kids, we should give a shout out. Ryan, any school listening at the moment, we will come to your school.
Yeah.
We'll do the session with you.
Yeah,
We'll do this live in person.
We'll leave Bryce there to do the follow-up sessions as well.
Yeah. I'll
Look,
as long as you want. We'll bring the books. We'll genuinely come to your schools. We love getting out there. We do it. So thank you for those that have invited us. But we are really passionate about this, obviously, because we talk about this day in, day out.
We've literally made it our lives.
We've made it our lives. Yeah, getting the word out there as early as possible is super important, and we would love to we'd love to come to your school or university.
Yeah, I think like we've learned that the benefits of financial literacy are, it's not even affecting your lives. Like the benefits of financial literacy are generational. Like if we can learn it, we can pass it on to our kids. They can be better with money, and getting on top of your finances is so important for every aspect of your life. And if there's anything that Bryce and I can do to help people feel in control of their money and think about how they can grow their money wherever they're starting, we would really like to be helpful. If you are interested in taking us up on this, head to equitymates.com/contact and let's chat. But Bryce, let's get to Ryan's question. Year 9 students, so what are we talking? We're talking
14,
like
15.
14 or 15.
I think so, yeah.
What were you doing at 14 or 15?
What was I doing at 14? Chasing girls.
I mean, to be honest, you were already investing at this age.
I was. That's true. I was 4 years into it.
Yeah.
Yeah. Still wasn't sure what was going on, to be honest, but getting very interested in it. That's for sure.
Yeah. So you're one step ahead of most of us.
Yeah.
So I think when we approach this question, we would probably not start with the stock market per se. I think for us, 14 or 15, year 9, like that's the right time to just get people in the mindset of how to think about money and how to think about money as a tool that can really like grow over time and unlock things in your life. So let's start with like, what are the 3 things we would try and teach year 9 students around money and investing in general?
The first one, probably the most important one, is to tell them that you have the most powerful tool on your side right now, which is free, and it is time. Teach them the power of Teach them the power of compounding, and I think the best way to do that would be to just show them that by investing, say, $10 a week for the next 40 years, they're going to have a lump sum of money that is probably going to blow their mind. $64,000, I think, is the number if you do $10 a week for 40 years at 8% a year. By the time they're 55, they'll have a pretty healthy lump sum of money. It will be hard to conceptualize, I think when you're in year 9.
We would call this first module, try and get rich slow, you just might do it.
Yes.
Or something like that.
You can be a millionaire.
Yeah. That's probably better than what I said, yeah. So then I think the second lesson is the personal finance lesson.
Yeah.
It's not how much you earn, it's how much you save.
Yeah.
And, you know, time and time again, book after book, expert after expert, we're reminded that the biggest determinant of your future wealth is your savings rate. And that's not my quote, that's Morgan Housel's quote. So credit where credit's due. But the book that probably illustrates this best is the book from the 1990s, The Millionaire Next Door. And they surveyed thousands of American millionaires and tried to draw out the habits and the common traits. And one of the biggest ones that was repeated over and over again was that millionaires are generally frugal. They spend less than they earn, and then they put that savings to work in investments. And so I think rather than thinking about earning more and more, which is obviously nice and is good, but really getting on top of that personal finance and then understanding that you can put that money to work and it can grow and it can work for you, super important.
I think that's a good age to have that conversation as well. 14, 15, might have some pocket money come in, maybe not too far off, if not just starting your first sort of casual job, KFC, Macca's, whatever it is. So I guess you'd likely have some actual cash to start putting into action. And then the final one is to try and get across the message that investing is not like gambling.
And I think contextually this module, if we're calling it that, this lesson is really important, because if you think about kids at 14 or 15, think about what they're bombarded with, like the absolute huge amount of sports betting advertising on TV, on social media. Like, you have no way to determine the difference between good financial advice, bad financial advice, and, you know, like the amount of like day trading influences
Crypto.
Yeah. So I think really unpacking what investing is and what gambling is really important. For us, Seth Klarman, the US fund manager who wrote the book Margin of Safety, wrote a really good chapter on this. Are you investing or are you speculating? And it's all about what you're actually buying. Are you buying something that is productive and that generates cash and can grow over time, and the value of the thing that you're buying is tied to the cash it generates? That's investing. Or are you buying something and the only way you make money from it is someone will pay more for it in the future? Because then you're just speculating on price.
Yeah. And I think this is such an important lesson, Ren, because even when I was at school, I had friends telling me that investing is gambling. Their parents were telling them that message themselves. They'd lost money in the stock market. Markets crash. You're just taking a punt. You may as well just keep your money in a bank account or put it into property. So I think getting this message across the line as early as possible, breaking that barrier, super, super important.
I mean, like the simplest one today is breaking that that idea that like investing in crypto and investing in stocks are the same thing.
So just to close those three out, the three modules we would come in and do, you have the most powerful tool on your side right now, which is time. It's not about how much you earn, it's about how much you save, and investing is not gambling. So those are the basics when it comes to money and money habits. Then, if you want to get us back for advanced class,
Equity Mates 102.
Equity Mates 102, just after lunch break, we would then bed down the basics of investing.
Or stock market investing.
Stock market investing.
At the end of the day, we're stock market guys. But look, we think when we're talking to younger people, we think the stock market is a sensible way to start investing for a number of reasons, some of which we'll touch on. The first one is it is the most accessible form of investing because you can start small.
That's right. I think the clearest example to illustrate to the kids would be showing how much money you need in property versus how much you need in stocks. These days, you can start with $1 investing in stocks. And then next to that on the whiteboard, I'd be showing the stamp duty that you need, the deposit that you need, the legal fees that you need.
Okay. We're not here to talk people out of investing in property.
I am.
But I think it's just...
You get the point.
It's important for, you know, like if we take it back to your experience, like you were investing as a teenager,
yes,
and like you were working the part-time jobs, and you already had that knowledge that you could save up and buy the drum kit, or you could put that money into your listed investment company that your dad
BKI
had first got you onto, and that money could grow over time. And like having that knowledge at that time, knowing you can start small and invest in small increments, makes it so much more real and accessible for people at that age. It's not like some far off dream where you're saving for a house deposit, but the house price is running faster than your ability to save. It's like this is something immediate that you can take action on now, and you can get started and you can build wealth. So I think demonstrating how accessible it is, how small you can start, and how you can get going and start chasing those dreams that you have, super powerful.
Absolutely. The second one is that you can buy a bit of everything. Here we'd cover off obviously the power of index investing, the ability to buy very simply and accessibly and affordably, literally stocks globally, and that's all that you need.
Yeah. Low cost, globally diversified index funds, one transaction. These days you can literally do it with no brokerage fees, and you can invest from $1.
So easy.
Investing
so easy.
Why wouldn't you
Why
do
wouldn't
it?
you? Yeah.
And then we would close with the showstopper price.
We finish on a high.
The kids might be getting a bit tired, might be getting towards the end of the day, but this is going to snap them to attention when we write on the board, the stock market is the greatest wealth creating machine history has ever seen.
That's it. And we'd put a list of the richest people in the world and show how they've all made money by owning businesses. And by owning businesses, you have people working for you to create shareholder return or to create return for you as an investor.
So you can this can be backwards looking, and you can say, over the past 125 years of the Australian stock market history, the Australian share market with dividends reinvested has returned 13% a year. 13% a year over 125 years. That's more than double the rate of inflation for people who always say, yeah, but inflation at this point. There was a study between 1900 and 2000 called Triumph of the Optimist, which looked at after inflation stock market returns. And Australia was either best or second best performing stock market after inflation did about 6.8% a year for 100 years. Incredible,
So good.
but that's backwards looking.
Yeah.
The question is, can it continue?
Yes.
And obviously, past performance is no indication of future performance, and we don't know what the future will hold. But why we're confident the stock market will continue to be such a great wealth creating machine is the incentive structures that are set up. So there are literally, if you look at the ASX 200 across all the companies in there, BHP, Commonwealth Bank, CSL, Woolworths, Coles, Telstra, there are millions of people employed by these companies, and all of their incentives are to make you more money as a shareholder. Because CEOs the board of directors keep their jobs if shareholders are happy, otherwise they get voted out. CEOs and executives, they get their bonuses and their stock options only if the share price goes up and they hit revenue targets and profit targets, and that all drives shareholder return. And then everyone who's employed in that organization, think about your job if you're listening and you're employed by a big company. All of your bonuses and your promotions are tied to you doing things that drive the company forward, that help the executives above you reach their targets, which help them get their stock options. The whole organization is set up to drive shareholder returns, to make you money. And think about that, millions of people working hard day in and day out to make you money.
So easy.
God, those kids are going to
So
be inspired
good.
after
Well,
that.
there you have it. Insight into Equity Mates 101 and 102 stock market basics coming to a school near you. But genuinely, Ryan, thank you so much for the question. We'd be happy to come and share a period with you at your school in Brisbane. Equally to anyone listening, head to equitymates.com/contact, shoot us a note. But if you want to just get started as well, a reminder, we have the ETF handbook that you can download. You can share that with all the kids in the classroom. If you're a uni teacher as well, share it with all of the kids at your university. Free to download, and it'll get them going with all the basics they need to start investing in the stock market with probably the most accessible and best way to start, ETFs.
Definitely. All right, well, we'll take a break here. On the other side, we're going to be joined by Adam Dawes as he reviews the portfolio of an Equity Mates community member in the latest episode of Pimp My Portfolio.
Welcome back to Equity Mates. It is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
This is a segment where we get a community member to submit their portfolio in the hope that it can be improved by the expert in our studio today. And the expert joining us is Adam Dawes. Adam, welcome.
Thanks. It's great to be here.
And on the line, we have Annie. Annie, welcome.
Thank you. Thanks for having me.
We appreciate you submitting. We know it's not easy putting your portfolio up for public scrutiny, but we're really looking forward to this one. Before we jump into it, tell us a bit about yourself.
Yeah, no problem. So I'm from the country originally, and I had an auntie who sort of suggested I started investing, back when I was in year 10 or something. So back then I bought a bit of, Commbank, Cochlear, and then never really thought about it. And then I went up into the Northern Territory to be a cowgirl, and I guess I just sort of sitting there and just noticed when I look back at it that it had worked well. And I guess the other thing is when COVID hit, it was that real life example of seeing it dip, and I sort of took an opportunity to buy then as well. And ever since then I've just been trying to educate myself, like listening to you guys or whatever it is. But I feel like, I'm a bit of a battler sometimes with it. I just do whatever I feel like at the time.
Love that. Are you still a cowgirl?
Sometimes I'm a cowgirl. I'm back in Sydney at the moment, but
Nice.
yeah. So
Nice,
so
nice.
that's it.
Love
Yeah,
that story.
I
Well,
guess. Yeah. The other thing, I guess, when I first started investing, ETFs weren't even a thing. So, I
yes,
mean, that's
yes.
sort of something I've sort of grabbed at in recent, in the recent second half of my investing journey.
Yeah, we are certainly the same. Well, why don't we get stuck into it, Ren? Take us through the portfolio.
Yeah, so Annie's portfolio, I've split into ETFs, some gold, and then individual stocks. Actually, the first portfolio that we've reviewed today that has gold in it. So that you'd be pretty happy with that over the past little while. But let's start with the ETFs. We've got about just shy of 80% of the portfolio spread across 9 ETFs. Globally, we've got VGS, the Vanguard International Shares ETF, and DHHF, Beta Shares Diversified All Growth, and the iShares Global 100. Then we've got a couple of US ETFs, Global X US 100, Beta Shares Nasdaq 100, and iShares S&P 500. Then coming home to Australia, we've got iShares ASX 200, Vanguard Australian Shares, and Vanguard Australian Property. As I mentioned earlier, gold, 5% of the portfolio in gold. And then we have 8 individual stocks: Commonwealth Bank, Cochlear, CSL, QBE, Rio Tinto, Scentre Group, Woodside. And actually, sorry, I've classified Beta Shares Crypto Innovators as an individual stock. Technically an ETF.
You can't have them all, Ren. You can't win them all.
There we go. That's my mistake. But that's the portfolio. Dawesy, we like to start with the nicknames. So,
I'm going to roll up my sleeves on this one because we're going to really need to get into this.
Okay.
So I'm rolling my
up.
sleeves up. You can't see me, Annie, but this one is a good layered portfolio, and it is a bit of a gold standard, right? So I think the sleeves are rolled up. We're ready to go. Look, I think overall, I think you're absolutely right. Everybody should have had 5% weighting in gold in their portfolio. A little bit tough now to start thinking about putting 5% weighting in gold, but I think everybody that did listen to you guys and listen to me a year ago, 2 years ago, when we were banging the table, everybody should have 5% weighting in gold in their portfolio. I think you've done really, really well with that. So congratulations on that. The other side of it is
I did listen to you guys on that decision.
Nice.
There you go.
We're wrong plenty of times, but when we're right, we'll certainly let everyone know about
it.
So, Dawesy, I guess thinking about the portfolio construction, ETFs, gold, and individual stocks.
Yeah.
How do you think about the structure of it? And then after that, we can jump into some of the individual names.
Yeah, so the structure of it, I think, is okay. I think, Annie, that you've sort of you've got an overlap, and I don't know if you're sort of aware of that, but certainly that overlap in that global, even in that sort of top 100 global space of those ETFs, you could definitely remove a couple of those ones. So I think portfolio construction is looking good. You've got some international, you've got some domestic, you've got some gold, you've got some crypto, so that's all fine. So I think it works well, just needs a little bit of fine tuning.
And so by that you mean there's obviously a lot of overlap between some of them here. And so it would mean either selling down some of the ones that have significant overlap and just putting them into, I guess, a fewer core positions.
Yeah, correct.
So, you've got the Global X US 100, iShares Global 100, Nasdaq Beta Shares Nasdaq 100.
Yeah.
Probably a lot of overlap there.
Yeah, definitely. And then with the S&P 500 in there as well. So, the S&P 500 is certainly the base of your portfolio because that's the top 500 companies in the United States or in the US. And then you've got the top 100 global ones. I think IOO is a really, really good one to get. Obviously, it's about 75% in the US, I think. So you're pretty much doubling up there. But I do like that top 100 companies globally. But then, yeah, certainly the NASDAQ and then those other ones in there that you've got, I think there's an overlap and you could certainly remove some of those to then make some room for potentially some other ETFs, maybe a European or an Asian ETF or sort of a real sort of global. I guess you got the Vanguard MSCI International one. So I think you got there. So you could top up some of those existing holdings with some of those sales. That would be my first sort of look or brush against the portfolio.
What are your initial reactions there, Annie?
Yeah, I think like when I hear that and I look at it, it was I look at my buying behavior when I got excited with ETFs, so I just thought, oh, I need to buy them all. Not that I bought them all, but then I listened to you guys. It's like you don't need all of them because there is overlaps and there's a lot of products on the market. So I guess and I find it hard to sell sometimes as well. So yeah, that's something on the horizon. Obviously, in the volatility in the last little while, haven't been looking at selling at all. But going forward in the next couple of months, I probably would. Yeah.
You're not alone in having trouble selling,
yeah.
Annie. We all struggle with that. It's easier to buy than it is to sell.
Yeah.
So we're all dealing with that.
And Annie, did you pick up any shares in this last sort of market turmoil, this last sort of volatility?
Yeah, so I went in and did the IOO again. Like I just wanted to top that up.
Great.
Because I just it'd probably be something I held on to, and I got rid of one of the other ETFs going forward.
Yep.
And I did buy a few different things, topped up a few of the things I already had, to be honest. I didn't buy anything new. I just sort of brought my dollar cost averaging down where I could.
Nice.
Yeah,
Okay.
so
Yeah, good.
Yeah. I think that resisting that impulse to keep buying new things and just topping up what you already have that you think is good, I think is good behavior. Something that I'm certainly constantly disciplining myself on, not chasing the shiny new thing. Dawes,
but it was hard to I wanted to just keep buying, so it was hard to be like, okay, just rein it in as well.
Yeah. No, I feel that. I want to ask Dawes about the VAP, Vanguard Australian Property, because we haven't seen that a lot in some of the portfolios we've looked at recently. But how do you think about that property exposure?
I recommend it to a lot of my clients. One, its biggest exposure is Goodman Group, and we've spoken about that, right? So that is probably the best REIT. So you get access to that Goodman Group, but then you also get access to, now in the real estate investment side of things, do you go industrial, do you go office, do you go supermarkets, do you go residential? And VAP just gives you all of that. So it's a really great way of capturing property. Now we know interest rates are going to, well, we don't know, but we suspect interest rates are going to fall May. So they've got the meeting coming up, and the market's pricing another 2 to 3 interest rate cuts this year. Right, so for all the homeowners out there, that means your mortgage gets a little bit cheaper, but that means also then those property trust sectors or those kind of VAP will start to increase in price as well as interest rates start to come down. So it's a really good hedge for your portfolio.
And then if we move to the individual stocks, how do you think about some of the names that we covered off earlier?
Yeah, well, Annie said that she bought CBA many, many years ago. She'll be very happy
Loving that.
on that
Year
one.
10.
Yeah, yes,
Was it?
yes. So I remember Dolomites. I'm getting a little bit old here, but the
That's it, Dolomites.
There you go, rightio.
I mean, imagine if Dolomites didn't open you a savings account, but got you to invest in Commonwealth Bank at that time.
Yeah, that'd be good. Yeah.
Cochlear is a fantastic business. There's just a little bit of selling that's going in Cochlear at the moment. There's a new drug coming out where they can basically take some amniotic fluid from the womb and can test if they are going to be deaf, and then potentially there's a drug that can stop some of that in natal deafness.
Wow.
So it's not well known, but there's been a lot of research done on it. So Cochlear has been a little bit of a sell in clients' portfolios because of this new technology that's coming out. So I'd be a little bit careful on Cochlear, but it's a fantastic business and a fantastic one. You do have a lot of healthcare being Cochlear, CSL, that's fine. Bit of an overlap with Centre Group and VAP, but I think that's okay as well. The sort of the weightings. And then also, just going back to the ETFs, you do have the IOZ and the VAS. So I would potentially get rid of one of those, and potentially the ASX 300 would be a little bit better than the 200. That would be my call on that one as well.
Nice. So that's for people listening, the Vanguard Australian shares and the iShares Core ASX 200.
Yeah.
Nice. Well, Annie, I think just to kind of sum up here, it's overall awesome job. I think there's some, fine tuning of the core portfolio, selling down some of the ETFs that I think maybe you're not as interested in, that have some overlap with the ones that you are more interested in, diversifying across maybe some other regions as well. If you wanted to think about Europe and the like, keep the gold.
Yes.
And the individual stock portfolio, I think, has got the gold standard tick from
Gold
Dawsey as
standard,
well.
that's right.
One thing we got to ask about. 30-second answer, Dawsey. BetaShares crypto innovators. Buy, hold, or sell?
Well, this is not advice. Please seek professional advice before you do anything. Look, it's okay. You don't have a huge weighting to it. I think you're okay. Crypto is part of the future, and it is an asset class, so I think you're okay with that. Don't put too much money in, though. Yeah, keep it to a 5% weighting in anyone's portfolio.
Nice.
Love
that.
Love it.
Yeah, I felt like I had to have a toe dipped in the water, even though it's a small amount, because it at least makes me watch what's happening with it as well.
Nice.
Yeah,
I think that's a good strategy.
It's a roller coaster ride.
It is.
Well, Annie, hopefully this helped. Keep going. I think there's a lot to like in the portfolio. So, you called yourself a battler, but I think you're being a bit hard on yourself.
No.
So keep it up.
Doing well.
Well, I know I did hear a quote once that said, there's never a bad time to buy shares, but there is a good time. So I think it's just sometimes I think like that. But like you guys say, you're like, just dollar cost averaging, fortnightly income, all that sort of stuff's really helped me keep it going, I guess.
Oh, that's good to hear. I think if you continue doing that, then you're definitely on the right path. That's for sure.
I might be borrowing that quote as well. Just
Yeah.
FYI,
Yeah.
that's a good one. I hadn't heard that before. Yeah.
Yeah, it is a good one. I think my brother told me that one time.
Oh,
nice,
kudos to your brother.
Yeah.
All right, Annie, we'll leave it there. But thank you so much for submitting. I hope you've got something out of what Adam's spoken through today, and we do appreciate you coming on the show. Thank you so much.
Yeah, thanks so much. Appreciated. And thanks very much for your time. Have a good day.
You too.
Thanks, Annie.
Bye,
You
Annie.
too.
And if you would like to have a one-on-one session with Adam, he has a professional portfolio review where you can sit down with him and his team and go through your goals, your risk profile, and get a statement of advice for your portfolio. $825, and he'll make sure that you're certainly on the right track. So head to equitymates.com/advice. There's a form there to fill in, and we'll connect you with Adam and the team. And if you would like to submit to Pimp My Portfolio and sit down with us here in the studio, equitymates.com/contact. We'd love to hear from you. But Adam, thank you so much as always.
It's great to be here. Thanks, guys.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.